Hi everybody. This second PowerPoint deck highlights the differences between modified accrual accounting as used in the governmental funds and accrual accounting as used in the governmental activities through a series of examples. I'd like to use this video to give you a quick introduction to the examples and to highlight some of the key differences in the accounting. I suggest that after you view this video, you go back to the PowerPoint deck itself and study the examples in more detail. Example 1, the accounting for the long-term debt. A city issues long-term bonds and pays interest and principal on the bonds. Our city issues $10 million of bonds on March 1st of 2010. No premium or interest in this example. So first the city would record the issuance of the bonds. We record the issuance of the bonds in the capital projects fund because we assume in this case that the proceeds are being used to fund construction or acquisition of a capital project. Note the difference in the accounting between the Capital Projects Fund and the governmental activities. In the Capital Projects Fund, the issuance of the bond is recognized with a credit to other financing sources bond proceeds. This is an income statement account like revenues. It is not a balance sheet account. While in the governmental activities, the issuance of the bonds results in a credit to bonds payable, a long-term liability on the balance sheet. 6 months later, on September 1st, the city records the first interest payment on the bonds. The entries are essentially the same in the debt service fund and in the governmental activities, with the one difference that in the debt service fund, which is a governmental fund, we record interest payments as an expenditure, while in the governmental activities, we record interest payments as an expense. Then, 4 months later, on December 31st, the city makes the necessary year-end accruals. In the governmental activities, we accrue 4 months of interest expense from the last interest payment date, September 1st, till the end of the year, December 31st, of $400,000 with an interest expense and accrued interest payable. In the debt service fund, there are no entries because in the governmental funds, we recognize interest expenditures only when they're payable and due. Then, 2 months later, on March 1st, the city will record the second payment of interest on the bonds and the first principal payment. In the debt service fund, we recognize both the payment of interest and the payment of principal as an expenditure. In the governmental activities, we recognize the payment of principal as a reduction in the long-term liability bonds payable. And also in the entries for the governmental activities, we recognize that we have already accrued $400,000 of interest expense at the end of the prior year. And so we only recognize $200,000 in additional interest expense on March 1st. Example 2. This is the same as example 1. The only difference is that the bonds are sold with a premium, in this case $400,000. And as is very common under state law, our city is required to use the premium for payment of debt service. It can't use it for the acquisition or construction of a capital project. Also, under the city's accounting policies, it will amortize the premium on a straight line basis. So first, the city records the issuance of the bonds on March 1st, as it did before. The only difference is that in the Capital Projects Fund, we record the bond premium as another additional financing source separate from bond premium. In the governmental activities, we record the premium as an additional liability of $400,000, which will be amortized over the life of the bonds. After that, we have to recognize the fact that the premium funds are restricted and can only be used for the payment of debt service. So we recognize that with the transfer of $400,000 from the Capital Projects Fund to the Debt Service Fund. This is an example of an interfund transfer. Next, on September 1st, the city records the first interest payment on the bonds and the first amortization of the premium. Again, the accounting entries in the debt service fund are the same as before because we don't amortize premium in the governmental funds. In the governmental activities, we record the amortization of the first $10,000 of premium, which results in a reduction in interest expense. Next, on December 31st, the city makes the necessary year-end accruals. Again, no entries in the debt service fund, and the entries in the governmental activities are the same as before, except that we also have to account for 4 months of amortization of the bond premium. Finally, on March 1st, the city records the payment of principal, interest, and the amortization of premium for the period from January 1st to March 1st. Again, the entries are the same as before, except for the additional amortization of 2 months of bond premium. Example 3, the acquisition of a capital asset. In this case, the city is acquiring a truck, has a useful life of 5 years, residual value of 0. First, we record the acquisition of the truck. Again, in the Capital Projects Fund, this is shown as an expenditure for capital outlay. We don't acquire an asset in the Capital Projects Fund, which is a governmental fund. But in the governmental activities, we record the acquisition of an asset, equipment. On December 31st, we record the first year of depreciation on the truck. There is no depreciation in any of the governmental funds, not in the general fund, the Capital Projects Fund, nor the debt service fund. But we do record depreciation in the governmental activities, in this case $20,000, 1 year's worth of depreciation. Example 4. In this case, the city purchased or sold a building that it already had for $3 million in cash. The building was on the city's books for $4 million, so there is a loss on the sale of the building of $1 million. In the general fund, which is where we record the receipt of the cash because there are no restrictions on the use of the cash, we debit cash for $3 million, of course, and we record the $3 million as an other financing source, sale of asset. We only record the flow of the current assets in the governmental funds, so we just recognize the cash coming in. In the governmental activities, because we had the building and its accumulated depreciation on our balance sheet, we have to remove that from our balance sheet, recognize the cash coming in, and recognize the loss on the sale of the building. Example 5, property taxes. The city bills property taxes of $611,000. It collects $600,000 during the year, $25,000 from the prior year, and $575,000 from the current year. Of the $36,000 uncollected at year end, $20,000 are expected to be collected in the first 2 months of the year. $20,000 are expected to be collected in the first 2 months of the following year, and $10,000 were expected to be collected in the following year, but beyond the first 2 months, and $6,000 were estimated to be uncollectible. So these problems are easiest to take one step at a time. So first, the city will record the levy of the tax, including making appropriate allowance for uncollectible taxes. In this case, the entries in the general fund and in the governmental activities are the same because we recognize uncollectibles in the same way in both modified accrual and accrual accounting. Next, the city records the actual collection of property taxes, $600,000 in cash coming in, reducing our property tax receivable by $600,000, just like the collection of any receivables. And again, in this case, the accounting is the same in the general fund and in the governmental activities. And finally, the city will make a year-end adjustment to recognize that $10,000 of the receivables will not be received until beyond the first 2 months of the following fiscal year. Therefore, they don't, under modified accrual accounting, meet the criteria for revenue recognition, remember, which is measurable and available. And in the case of property taxes, GAAP says that available means it will be received in the first 2 months of the following fiscal year. So in this case, in the general fund, we reduce the property tax revenues that we have previously recorded by $10,000 and recognize a liability, deferred revenues for the $10,000 in property taxes that we will not recognize as revenues this year, but will be able to recognize as revenues in the following year. In the governmental activities, we make no adjusting entry because the measurable and available rule does not apply under accrual accounting. That concludes these examples of accrual versus modified accrual accounting. Again, I suggest you go back and read the PowerPoint itself more carefully and in more detail. And if you have any questions about these examples, please post them in our discussion area. Thank you.